Today is going to be a really interesting day. What will it do when the report comes out at 11? I think the upside on the daily, weekly, and monthly charts is small. However, look at the daily chart. Let me put up the day session. We have a lot of bull bodies there. Was that 8 consecutive bull bodies? Yes, parabolic wedge, 1, 2, 3, but 8 consecutive bull bodies. And yesterday is an inside day, and therefore a buy signal bar, and we're triggering the buy right now by going above yesterday's high. We have different measured move targets. The obvious one is simply based upon the height of this range. And I would not be surprised if, given how strong the daily chart has been over the past month, I would not be surprised if we get a very strong breakout on the report, 10, maybe even 20 points, and then a reversal and a parabolic wedge, 1, 2, and 3, or 1, 2, and 3. So I think we're not going up much higher, and that is why I bought puts and put spreads, but I'm holding way out to January because usually when a market looks like this, it's not going to go straight down. However, because today is such an unusual event, just because it would be unusual for it to go straight down, we have an unusual event, so today would be the kind of day when it could go straight down, even though it's low probability. And it could go down pretty quickly. And that's why I was willing to put on puts and put spreads earlier than I might otherwise. I mentioned on the VXX that this is not a market that looks like it's going to reverse up, and that's a sign that buying puts and put spreads in the E-mini is probably early, but what's different is we have a very unusual event today. So even though our big rally on the VXX, a big sell-off on the E-mini is unlikely, the probability is higher than it would otherwise be when you look at a chart that looks like that. Anyway, right now we have a failed breakout above yesterday's high. Everyone is hesitant to swing trade because the past 7 or 8 days have been limit order markets within very tight ranges. However, sometimes on an FOMC day, you do get a swing or a breakout before the report. Sometimes it happens right from the open of the day. Sometimes it happens, 30 or 60 minutes before the report. Anyway, first part of the day, let's say it's a bear bar closing on its low. Then we have a failed breakout above yesterday's high, 60-minute chart, possible final flag. We're late in a bull trend, sideways here, extremely tight here. So it would be a reasonable swing short. As for scalping, a short below 1, the math is just not good enough. You're selling in the bottom half of a trading range that's going on for 4 hours, and it's very tight, and you're at the 5 and 15-minute moving averages. So the limit order trade is selling the highs, selling yesterday's high. And I would not do that yet either. And you can see some traders were smarter than me. Instead of selling yesterday's high, they put a limit order to sell 1 point above. You can see it went 5 ticks above. So the stop order traders who bought as it went above yesterday's high right now are trapped. And the limit order traders have already made money in the first minute of the day. Okay, market is possibly setting up a swing short. Remember yesterday, first part of the day, I said it could be the high of the day. And I am saying the same thing here. But the probability is not as high as traders want, because look to the left. We have 50 bars in a 2 or 3 point range. So more likely we'll continue sideways here, especially if it has a 2 or 3 tick tail on the bottom. Okay, there's your bar. You see in the final fraction of a second, it went from a 2 tick tail to a 3 tick tail. the computers made it even more neutral. It can still be the high of the day, but the bears need a good second bar. Like yesterday, we had a bad stop entry bar for the first bar, but the second bar became a good bar. So that gave us 10 minutes of strong selling, and it increased the chances that bar 2 was going to be the start of a swing down. Here, more likely buyers below 1 and buyers below the 47 bottom of the range. 60-minute moving average, not far below. Yesterday's range, small, increases the chances today will be an outside day, which means we go above yesterday's high, which we just did, reverse down, which is what we're doing, and then fall below yesterday's low. But not a good sell signal bar. Bulls, like yesterday, hoping for a reversal up, a brief sell-off to support the moving average, and then the start of a bull trend. Bar 1, a bad sell signal bar. Bulls trying to create a decent buy signal bar, which they did. So, this is a reasonable, let me just say right now, I'm not buying above 2. I'll wait to see if we get consecutive strong bull bars. But it is a reasonable buy for a possible low of the day. For the bears, they want another failed breakout above yesterday's high. One broke above yesterday's high, reversed down. And they're looking for a second entry short below 3. So 3 is an important bar. It's an information bar. If it's a bear bar closing on its low, it would be a reasonable short for a failed breakout above yesterday's high. On the other hand, if it's a decent looking bull bar, let's say a 4 or 5 tick bull body closing on its high and above the 1 high, it would be a reasonable buy the close bar for a rally. So doji here and a couple bull bars went up at least a little bit more. Everyone on the open, I think there's a tendency to expect moves. Most traders know that whatever move you get on the open has a 50% chance of reversing, and that includes the second move as well. Yesterday we had a strong move down, 50% chance it's going to fail, and then we had a big outside up bar here and 6 bars without a bear body, so a good move up, 50% chance it's going to fail, and we went to a new low. And another breakout, 50% chance it's going to fail. Until the market clearly is trending and starting to get consecutive decent trend bars, you have to assume every breakout, no matter how strong it is, has a 50% chance of failing. Okay, to see the problem bar 3, here we are 2 minutes into the bar, and instead of racing up and immediately telling traders that we're going a lot higher, it's hesitating, and traders are aware that it could fail again like bar 1. So always in long, we never went back to always in short yesterday after bar 25. So we're still always in long, and we're at a new all-time high, and we reversed up on a pullback, but not yet strongly bullish. And yesterday, a bad looking buy signal bar on the daily chart. We have a buy climax, a weaker buy climax, and a pair of dojis and a parabolic wedge, 1, 2, 3, or 1, 2, and then 3. And a pair of dojis, not a strong stop entry setup. So what do we do? What do we need to see to sell below 3 for a second failed breakout yesterday's high? The better the bear body, the lower the close, the higher the probability. The probability is never going to be as high as anyone wants when you look to the left and you see 50 bars in a very tight range. But the bears need a pretty good bar. Otherwise, traders will assume that this kind of trading will continue. Bulls trying to get a decent bull bar. Trying to break above the range. The bears trying to get a double top, and the bulls are trying to get a bull breakout above the double top, and then a measured move up. For the bears, they have a double top and a neckline. They wanted a measured move down, and instead of breaking below the neckline, we're breaking above the double top. So the measured move target is in the opposite direction. Do I think we'll get there before the report? Probably not. That would be a pretty big move up going into an FOMC report. But we might get here, a measured move based upon this tight range. 60-minute chart, top of a very tight channel. I don't have the top of the channel drawn in, but we have a parabolic wedge rally. Back to the 5-minute chart. Okay, consecutive bull bars, neither one big, but always in long, and not a good sell signal bar on 3, so probably buyers below 3 and buyers below 2. Anyway, everyone is looking for certainty, and bars 2 and 3 increase the probability, but not especially high. Also, everyone knows that even if we do rally, we probably will not get all that far up before the FOMC report. Sometimes you'll get swings going into the FOMC report, sometimes on the open, sometimes in the hour or so before the report. When you start to get a swing right before the report, 50% chance it'll continue when the report comes out, 50% chance it'll reverse. I think most traders should be flat going into the report, and they should wait at least 2 bars before taking a trade, because the initial bars are big, and there's a 50% chance they'll reverse. And since the bars are big, the stop is far, your risk is big, and you have a 50% chance of losing a lot of money. And that's not a good way to trade. Bulls trying to get a 3rd bull bar, 4th bull bar, trying to break to a new high of the day. They're hoping that we enter a strong by the close rally. But, here we only got 2 bull bars. Just over here we got 3 bull bars. That's part of the problem the bulls face. Here we got 2 bull bars. We got a pullback, then a little bit more up. But part of the problem the bulls face is that breakouts up and down have only lasted a few bars. Here 2 bull bars reversed, second entry, bad first entry, second entry not all that good, but at least it has a bear body. So for the past week, traders know that breakouts up or down have only lasted 2 or 3 bars, and while this is by the close, the odds are it's not going to go up all that far. So it's not a great buy. That is actually a sell signal, right? We've rallied above yesterday's high and then traded below bar 1. And here we're rallying again above yesterday's high and reversing down a second time. However, we have consecutive bull bars, and that is a low probability sell. Failed breakout yesterday's high, became the high of the day. This is the second entry short. It went below a bear bar, and then it went outside down below a bull bar, and that became the high for most of the rest of the day, even though it was a bull bar. This is a better short. even though we have three decent bull bars, failed breakout below yesterday's high, and then a second one, and the second one has a bear bar for the sell signal bar. Same here. It triggered, here's the first, here's the second, and it never went above the high of the sell signal bar, so theoretically the swing bear stayed short. First reversal down, second reversal down, became a triangle, but ultimately this ended up as the high of the day. First reversal down, second reversal down below a bull bar or a doji bar, not particularly bearish, higher probability to wait for a bear bar and then sell below the bear bar. And it tested that bear bar low, tested it again, and the bulls gave up. IOI, first, second, reversal down from above yesterday's high. First, second, and IOI again. Now, is this one of those breakout mode patterns? After the first bar, we went below the low of the first bar and then above. And then we get up to the high of the first bar and reversing down. If the pattern does not have enough bars to be a breakout mode pattern, even though we reversed up and then down. So while we might break below 2 and fall for a measured move, I won't consider it a breakout mode pattern, not yet. It's too small. You know, we have a decent chance of having an outside down day today because yesterday's range was so small. And if we do not get it early on, we have that FOMC report coming out, and that will result in a big move, and that could create the outside down day. So bears selling either below 3 or below 4, second failed breakout yesterday's high. Always in short. I'm not opposed to being short. You know, I think there's probably a 50% chance, maybe higher, that we'll trade below yesterday's low at some point today. I don't know that we'll get there before the report. Do you sell on a stop below 2? You know, I wouldn't think of it that way. I would think of it more as, you know, simply selling a sell to close trend. But, you know, the market at this price level reversed up repeatedly yesterday for 4 hours. So selling here is at a support level. I made a mistake. I was typing and talking. I should have sold below 4, a bear bar. You know, I showed an example of that where 3 is not a good sell signal bar, and you wait to sell below the bear bar, which is the 4 low. For the bulls, high 2 bull flag. We have a sell-off to the moving average, reversal up. We're slightly lower low, trying to reverse up again. Like yesterday, we had leg 1, pull back leg 2 to a lower low. Leg 1, pull back leg 2 to a lower low. Both times we had a rally. Right now, the odds are there are sellers above 6, no matter what it looks like, even if it is a bull bar closing on its high. Let's say it is a bull bar closing on its high. What do you do if you're a bear? It's still in the swing short, stop above 4, but obviously the probability for a swing is not that high anyway. And then if you get bar 6 looking like bar 21 yesterday, right, the probability is even lower. So right now I think we're always in short, and there probably are sellers above 6, but you know, we went down on 1, up on 3, down on 5, up on 6. So, 4 legs in the first 6 bars. Not a very good environment for swing trading. The bears are not going to sell the 2 high. It did not get above 1, so they could not sell up there. So not a lot of trading so far. Still on the short below 4, but a bad follow through bar 6 and bad environment. We're back in that tight range. Again, daily chart. Yesterday's an inside bar and a bull trend, so a high one buy signal bar, but 2 dojis, it's a low probability buy. And again, yesterday's a small day, 50% chance at some point today we're going below yesterday's low. $40,000 contracts bar 1, and bar 2 only 17,000, and then 15 or 16,000. So volume not very big. Always in short, but why are we doing this? Why is 6 a bull bar? Why is 7 an inside bar? For 4 minutes like this, there's just no energy. There's no sense that the price is terribly wrong and that we have to quickly move to a better price. In general, second failed breakout yesterday's high, 60% chance you're going to make at least 2 to 4 points. But I don't know if my mic was on when I was showing examples that it's not 100%. You can get a second failed breakout and then the market still goes to a new high. Here, second reversal down from above yesterday's high, yet we still rallied very strongly. For the bulls, it's a wedge. Reversed up on 2, reversed up on 6, and trying to reverse up on 8, and it's another higher low. And for the bears, they're hoping it's a pullback from the 4-5 reversal down. To me, it's probably better to wait. It looks like a continuation of yesterday's trading, and it's in yesterday's range, so always in short. But look at this, reversing up on 6, reversing up again on 8. This is not how bear swings typically begin. And what happens below the trading range? Probably buyers below. I think we're going to go below the trading range. I think 50% chance we'll end up going below yesterday's low. Again, I don't know if we'll do it over the next hour or so, but I think we'll do it today, maybe on the FOMC report. Not a good buy signal bar, still always in short, but terrible follow through after 5 and after 7. And the location is bad. We're right above support. You don't want the market stalling at support. You want it to collapse strongly below support with a series of big bear bars closing far below support. That has a higher probability of a successful bear breakout. So always in short, but really not doing what the bears wanted to do. 15-minute chart, reversing down from the top of a channel, wedge, day session, 2-bar reversal, failed breakout. Bulls still hope it's a wedge bull flag, and bears want the breakout and measured move down. I am flat. I think the probabilities are very close to 50-50. The bears have a slight advantage because of 4-5, but the follow through has been terrible, so the advantage is not much better than 50-50. The market wants to find out what's below the tight range, so we probably have to get below 80 and probably below 48, and then the next target is yesterday's low and the 60-minute moving average. What about limit order bulls? It's reasonable to buy below 80, but you probably need a wide stop. You probably have to put a stop a couple points below yesterday's low. A wedge with 5, 7, and 9, but a bad buy signal bar, and for the bears, a bad breakout. Right, we have a big doji bar instead of a close far below the trading range low. We're closing above the trading range low, so it looks like an early trading range, which is buy low, sell high scalp, and second entries are better if you're ever unclear. And now we have a 5 or 6 bar bear micro channel. Even though it's a wedge, it's still probably better to wait for a second entry buy if you're looking to buy with a stop. We're still always in short. The bad follow through on 6, 8, and then the tail on 9 makes a lot of bears unwilling to sell here. Bears are willing to sell low when the momentum down is very strong, and this is not very strong, so most bears only want to sell higher. If it becomes very strong, then they'll sell low, but right now the bears only want to sell higher. For the bulls, this is the buy zone, bottom of a tight range. You have some bulls buying with limit orders. As soon as they see a bear close on its low, they buy. So they buy the 6 close, they buy the 8 close, they buy the 10 close. If they get to buy below bars, below 80, below 47, they buy. Seven bar bear micro channel, always in short. Not a good buy above 10. It's better above 11, but it's still a bear micro channel. A lot of the bulls will want a second entry buy. More likely sellers here at the 10 high. We may test yesterday's high again, right? The market kept testing this price yesterday, so it's a big magnet. We broke above it and we failed, but the reversal down is not strong, so it's still a magnet, so we may have to get back up near yesterday's high again. Trying to do like yesterday over here, bear flag and then bull breakout, and so far this is still a bear flag and still more likely to go down than up, but I think most traders should just wait. This is bar 12, the final bar of the hour, and we have an outside down bar, but a big tail on it and a tight range. So not much help, not much information about the direction of the next move. Best choice right here is flat. Second best choice, short, stop above 4, taking a chance that we've seen the high of the day. Right now, bar 10, there's at least a 50% chance we've seen either the high or low of the day up to the FOMC report. right, chances are we're going to get a very big move on the FOMC report. I'm sorry about that. The bears see a wedge, 1, 2, 3, and the rally, they see it as a double top, and they're looking for a break below the neckline of the double top, and then a measure move down to the 60-minute moving average from yesterday's low. The bulls want a reversal up like yesterday. Yesterday we had one bear bar. Today we have two decent bear bars. So I think this is slightly more bearish than yesterday. Bar 10, and by the time you get bar 7, you have at least a 50% chance that you've seen either the high or low of the day. Since we're going to get a big move on the FOMC report, I think instead of high or low of the day, high or low of the day up to the report, and the day more or less starts over again with the FOMC report. In other words, the day will pretty much ignore everything to the left. Bulls trying to get a repeat of this. However, this had one bear bar. Today we have two decent bear bars. This we had 4 bars without a bear body. Here we have 2 bars and then a bear body. So I think this is less likely to go to a new high than this was. So I still think probably we'll get a lower high. But we have a big magnet up here. The market tested it 10 times yesterday. We broke above it twice today, could not hold the breakout. We reversed below it, did not get far below it, and therefore we still have a magnetic attraction at these highs, which is right around yesterday's high. Bulls trying to get there, break out above the bear flag, and then back up above the high of the day. More likely, this is a bull leg in a trading range. So we went down, we went up, we went down, we're going up, and we'll probably get a lower high. Probably stall, around yesterday's high again. Bulls trying to get their breakout on 14, comparable to 24, except, this is not looking all that good. We might get up to yesterday's high, the top of that range, but it looks like we're still going to stay sideways. We're still always in short, but as I said, the bears had terrible follow through on the way down, and therefore it's probably a bear leg in a trading range. The bull reversal is not good yet, and it looks like a bull leg in a trading range. The limit order bears 10 high probably will make money. Some of them are trying to sell 1 point higher, so instead of selling the 10 high and 1 point higher, they're simply trying to sell 1 point higher and maybe 2 points higher. For the bears, a double top 6, but I think the range is too small for most traders to trade. I'm not opposed to selling 1 point above 10, but most traders did not get filled because it had to go 5 ticks up and only went 4. Can you buy below 14, betting that we have a wedge bottom and we get 2 legs up? Well, we've already had 2 legs up, 1 pullback, 2. I still think we're always in short, but it's really difficult to structure trades here. The range is just too small, so the risk is big relative to the reward, and therefore you need very high probability, which you cannot get. Still always in short, but really tight range. I think probably better to be flat. FOMC, This is the old days. This is back in 2012. FOMC often had big trends on the announcement. You can see it sold off a tiny bit and then rallied strongly. Second bar here is important. It did not have a bear bar, and therefore it was minimum follow through after the big breakout. A lot of traders were concerned by the big tail. They have a big body closing above all the prior bars, and they need a follow through bar, and they had a doji here. But if you buy it, your stop is way down here. You know, on this particular day, that was about 4.75 points for your stop. So if you're going to buy above that bar, your stop is here. Then high one, high one, high one, then high two, and then a little bit of a climax at the end of the day. But this is not the way FOMC report days have been over the past couple of years. Previously, we had a lot of trend days. Here we had a big trend day up. Now we have a lot more trading range days. Another example. I said 50% of the time, the initial move is wrong. You can see we sold off, reversed up. Let me go back here for a minute. Looks like we're trying to get the bear breakout. The bulls failed to get their reversal, just like they failed twice to break above yesterday's high, and went the other way. And they tried to reverse up, and now they're failing, and we're going the other way. There's a probability much more than 50% that will go below yesterday's low. I don't know if it's much more, but I think it's better than 50-50. We'll get below here before the end of the day. Limit order bears 10 high. Need one more tick. They'll probably get it. We might get vacuumed down to the 60-minute moving average. When the market breaks below support, it then usually looks for the next support level. The bulls are hoping the next support level is this, and that we're in a wedge bull flag. And the bears want the measured move down, double top, neckline, measured move down. You can see the hesitation. So you have some bulls buying the 10 low. In general, whenever you have a breakout, 50-50 chance you get a leg down, 50-50 chance the breakout fails and reverses up. On a trading range day like this, continuation of yesterday, you know, the odds are slightly better for the reversal. Five ticks below the 10 high, so the limit order bears bought. You know, they got their 1 point scalp and they bought. So part of this bounce on 18 is from bears buying. They're just happy to get a 1 point scalp. What happens if 18 closes below 10? Then we have a gap. Maybe we'll get the measured move down. Well, you know, even if we do get below yesterday's low, there probably will be buyers there. We have the 60-minute moving average, yesterday's low, 15-minute chart, you know, so probably buyers somewhere here. Might get vacuumed down. We might accelerate here to get down to the next support, 60-minute moving average, yesterday's low. Good bar for the bears, good context for the bears. Bulls still hoping for the failed breakout, and the bears want to get down to the next support level. Who's going to buy above 19? Let's say it has a 4-tick bull body closing on its high. then bulls might buy above. But if it's not especially strong, we'll probably get at least a small second leg down to the next support level. NASDAQ has been having some very, very big moves past few days, just crazy big moves. Different ways to draw a wedge. One is reversal up, third reversal up. At this point, a lot of traders are thinking about the day being an outside down day, and the bulls do not want to give the bears that sign of a strength, so they'll buy to try to prevent it from happening, and the bears will sell trying to accomplish it. I think a lot of traders will not buy above 19. They'll wait to see if we get 2 or 3 bull bars and then buy, arguing 18 is enough of a surprise so that the odds favor at least a slight second leg down. Limit order bulls who bought the 10 low and 1 point lower need one more tick. Since the screen is a trading range, the odds are we are going to get above the 10 low and the limit order bulls will make money. Bears selling right here, 1 tick below 10, hoping to trap the bulls, but the odds are, with all this trading range trading, we are going to get above the 10 low. I think the math is difficult here. The bulls have a wedge, a reversal up from above yesterday's low. They have a good buy signal bar, but good enough momentum, 17, 18, probably a minor reversal, and we'll have to test back down within a few bars. So it's a possible low of the day, but not high enough probability for a stop entry scalp. And for a swing, if it is going to be a swing up, then we'll go up for an hour or two, and it's higher probability to wait to see if we start to go up more than just 1 bar. And 19, the bears are not going to sell the 19 high. We have a wedge bottom, a failed breakout, limit order bulls made money, so the bears do not want to sell a good looking buy signal bar when there's a buy setup. In a trading range, when you get a reversal up from a new low and the sell-off is fairly strong, it's a significantly higher probability to wait for a second entry buy, like a micro double bottom. For the bears, 19 is a pullback, 20 is a pullback, so it's a stop entry short below 19, stop entry short below 20, but terrible follow through and a wedge with a decent bull bar. So I think most bears do not want to sell with a stop below 20 or 19. And I would not sell with a limit order at the 19 high. So this is, I think, a bad location to be putting shorts on. If it's bad for the bears, it's good for the bulls. We're in the buy zone around 60-minute moving average and yesterday's low. Still always in short. Nobody wants to sell. And the bulls want a second entry buy. We could get an IOI here. That would be a second entry buy. That would be a higher probability buy than buying above 19. You have a micro double bottom down 18, up 19, down 20, trying to go up 21, and therefore it's a second entry buy above 20 as well. The bear trend tried to resume down on 20, and the bulls are trying to reverse it up again a second time, but it's forcing bulls to buy fairly high up. Bulls preferred to get a chance to buy at the 18 low or around the 60-minute moving average for yesterday's low, and it does not look like they're going to get it. Not a good looking stop entry buy. What do the bears do? It's a trading range, and I think most bears get out above 19. I think the remainder will get out above 21. A second entry buy after selling off for 15 bars or so. And for the bulls, I don't think it's a good stop entry buy. And the limit order bulls who bought 1 point below 10 have already scalped out. Other bulls wanted to buy, below 19 or down here, and they're not getting a chance. So for me, I'm trapped out. Where will sellers be? Well, stop order bulls who bought above 19 have the limit order to sell 5 ticks higher. So therefore there's resistance 5 ticks higher. So bears will be selling 4, 5, or 6 ticks above 19, which is in this area. The bears still have a double top with 19, but who's going to sell below 22? Not many traders. We got a wedge, and we have 3 decent bull bars in a general area of support. Failed breakout below a trading range and just above yesterday's low and the 60-minute moving average. So probably more buyers than sellers below 22. Remember I said that the market was always in short on the 5 close, and therefore traders sell the close. Some traders will hold for 2 points, 3 points, 4 points, and the 2-point bears need the market to fall 9 ticks below the 5 close, and that's exactly what it did at the 18 low. So some of this buying is from sell the close bears 5. It had to fall 9 ticks, which it did, and some of this reversal is from those traders. It's also a 5-tick trap for the bears who sold on a stop below 10. Because of those 3 bull bars, a lot of traders will not sell with a stop here. They'll want to sell higher, or they'll wait for the market to go sideways for a few bars before looking to sell. Are we always in long yet? We have a wedge bottom, and we have consecutive bull bars. I think the bulls need to do a little bit more. Let me go back to those FOMC reports here. This is a 10-point sell-off, and then a huge rally. We rallied 35 points in a series of high ones. Would I sell this? No. Consecutive big bull bars, big outside up, probably buyers below that bar. But if you buy that low, your stop is way down here, 20 points, right? And huge, bars, so huge risk. You could buy with a stop above here, initially put your stop there, but then quickly move it up. Once you get a breakout here or here, you'd raise your stop below here or here. And the market just continued up all day. Huge breakout. The bears tried to reverse a second time, but it became a high 2 bull flag, high 1, high 2, testing near the moving average. I would not take that short. A big enough bar to make me wonder if we're going to get follow through. We have a bull bar here, a bull bar here. I would not take that short. To me, the buy is above this bull bar, and we got a wedge. Very deep pullback. Sometimes on an FOMC report, you become always in long. We have a outside up bar, a follow through bar, always in long. The bears have 3 consecutive bear bars, but testing the breakout point and the moving average, traders would either buy above that bar or they'd wait for 2 or 3 bull bars and then buy. And it trended up the rest of the day. Here, always in long, but big reversal down. Could not get below the bottom of the initial bull breakout. Went sideways, and the bulls got a second leg up. I think, this is difficult. It's always in long, but not breaking strongly above all the bars to the left. You'd buy over here for a second leg up. You'd probably get out here, a bear IOI. FOMC report. We sold off. No, we rallied. No, we sold off. No, we rallied. Right. So lots of reversals. This is June this year. Remember, in the past couple of years, we've had many more reports where the market has had multiple reversals. As I said, 3, 4, 5 years ago, the market tended to trend more on the reports. This is 2015. It went up on the report. It went down on the report. And then we got a double top bear flag and then a series of bear bars, and we had a sell the close finish. Up on the report, down on the report, became always in short, probably with that second bear bar. Again, the initial move was wrong. It went down. That's wrong. It went up. That's wrong. And the third move was the one that led to a swing. Here, it went up. No, it went down. It went down a second time. Consecutive sell climaxes, tried to reverse, and now we have a pullback from the reversal. That is a reasonable buy. I think you can buy here, or wait until you start to get by the close. Again, that's 2015, when you tended to get more trends. And here, we went up, we went down, we went up, and just a trading range. We got a late breakout, did not get very far. This has been more typical of what the market has done in recent, the past 5 or 10 reports. Again, it went up, it went down, it reversed up, and, reversed down again. This is 2 years ago, 2015. Here, it went up, it went down. Again, at least 50% of the time, the market will make a strong move in the wrong direction and then reverse. And, you see the reversal and then you see bear doji, the market becomes unclear. We enter a triangle, and by the time it's clear, it's already down here and there are only a few bars left to the day. A lot of trading range trading going into it. We went down, we went up, bad follow through, and, not much to do, right? This is about a year ago. So the takeaway is that the initial move has a 50% chance of reversing, and ultimately 50% chance when you do get a move, it'll be down, 50% chance it'll be up. Past couple of years, we've had much more trading range trading after the report, much more confusion, and much less strong trends. Okay, we're back to always in long. Bulls trying to get above 14, and this is probably comparable to 25, 26 yesterday, if it closes up here. In this general price area, we sold off many, many times yesterday, and we may try to reverse down here, but if this bar closes near its high, then always in long, and traders will look to buy. Certainly buy below bars, betting against the double top. For the bears, double top, neckline, and they want the measure move down. But if it closes up at the high of this bar, that would be enough to make traders believe the odds are buyers below. Can you sell one tick below the 14 high or above 14, betting that it's a trading range and limit order? Bears, therefore, should make money. This is strong enough up, so I would rather wait for it to go sideways for a bar or two before taking the short, or I would look to short higher up, like a point above 14, not right here. And for the bulls, they know that it's probably a bull leg in a trading range and that it's probably not going to go much further. Some bulls will buy right here on the breakout, but most would rather buy a pullback, betting that the first reversal down will fail and that we'll get at least a small second leg up. Nine ticks above 19, so you get some bulls trying to take 2 points out and they have a limit order. 9 ticks above 19, they bought with a stop 1 tick above. It has to go 9 ticks more to get filled. We're testing yesterday's high. We're at an area where the market sold off many times yesterday, but 24, 25, strong enough so that I think we are always in long. So I would wait for a second entry sell. Can the bulls use a tighter stop like below 24? I don't know. They might be able to, but I think right now it's better to have a stop below 19 if they're long, if they're buying here above 14, if they're buying below 26. 60-minute chart. First hour was outside down, but a doji in a tight range, not a good looking sell. Second hour is a reversal bar, but a bear body, a small bear body, and the top of a tight trading range, not a good looking buy. So it looks like more sideways, so it looks like probably sellers above the first hour's high. A second hour's high, which is this high, probably will not go up very far. Because it's a trading range, a lot of the bears will want a second entry sell. They had a second entry sell here, below 1 and then below 304, and they have a second entry buy here, above 19 and then above 21. And the bears will want a second entry sell up here. So that means probably buyers below 26. Let's say it's a bear bar closing on its low. Will bulls buy it? It's similar. That would be similar to the bears down here. If you have a bull bar closing on its high after a sell-off, and you have a lot of trading range price action, the bears do not want to sell that high. They don't want to be selling above a bull bar at the bottom of a range. And the bulls do not want to buy below a bear bar at the top of the range. So if 26 closes on its low, a lot of the bulls will wait. Is this a second leg trap? We try to get a wedge bear flag here, and then we get a bull breakout. It's a tiny second leg trap, maybe in a smaller time frame, but I still would not sell below 26. And if you buy, your stop is still below the low of the day. For the bulls, they see resistance, yesterday's high, and they're not confident we'll break above it. And a lot of them would like to buy with limit orders, but they know that if they buy, the market may stall here again. If they buy with a limit order, it has to go up 5 ticks to make a profit, and therefore they would like to buy at least 5 ticks below yesterday's high, the blue line. Probably a minor reversal, we're probably going to go sideways here, and the market will decide whether to break again above yesterday's high, like we did here, or stall and form a lower high. When you have a day like this that tries to go outside down, but reverses up above yesterday's low, sometimes it goes back up. We went outside down, reversed up. This is what I'm talking about. We've, on the open, went above yesterday's high and repeatedly failed to get much above yesterday's high, and then we sold off strongly trying to break below yesterday's low, but could not get below yesterday's low, and we reversed up. Today we reversed down from above yesterday's high, could not get below yesterday's low, and reversed up. Traded above yesterday's high, sold off. The bulls tried to prevent it from getting below yesterday's low, and they got a reversal, but in the end, the market eventually got down below yesterday's low. Traded above yesterday's high, far above yesterday's high, and then reversed down, went far below yesterday's low, and bounced at the end of the day. Anyway, this is similar to today. Reversed down from above yesterday's high, sold off, could not get below yesterday's low, and then reversed up. Same thing, could not get below yesterday's low, reversed up. What are the chances that if we break above the high of the day, this becomes a big bull trend? The chances are small. The market probably is going to stay sideways going into the FOMC report. After the report, we could get a huge move up or down or both. Here's a 50% pullback around the moving average, around the 21 buy signal bar high. So the bulls would like to buy in this general area, about 4 ticks below the 26 sell signal. Limit order bears who sold the 14 high needed to fall 5 ticks to get out, which is also in that same area. Now, can you sell above 26, betting on a failed breakout and a wedge? Reversal down, second reversal down, third reversal down. Bears looking to sell above 26 would like to get a pullback here first. That would increase the chances that they could get a second entry sell. If we just keep going up like this, a lot of bears will not sell above 26. Right now we have a microchannel with 9 bars since the 18 low, 9 or 10 bars. And a lot of bears do not want to take a first stop entry sell when there's a bull microchannel. That's comparable to the monthly chart. We have an 11 bar bull microchannel. First reversal down probably will only last 1 or 2 or 3 bars. And same here. First reversal down probably will only last 1, 2, or 3 bars. So while I think the market is going to pull back, I do not think it's going to pull back far, and I think the bulls will buy it. Bulls, they have an II bull flag, a pullback from the breakout above this double top, but we're at the top of a trading range, and a lot of bulls do not want to buy high. They want to buy a pullback, not a breakout. In fact, this is an III, 3 consecutive inside bars. Bulls would like the micro channel to end. They want to see a low going below the low of the prior bar. And the bears would need probably a second entry short. So this would be the first, and then after another rally, the bears would look for a second entry short like this. Here's the first, and then there's the second. More likely buyers below. The problem the bulls have is they're only 4 ticks below the resistance of yesterday's high. A lot of bulls, if they're buying, I think will trade small. Other bulls will wait to buy lower, 2 or 3 ticks below the III. Stop order bulls, I'm not sure that it's worth taking the stop entry buy, even though we're always in long. It's the top of a bull leg in a trading range, and trading, buying high, betting on it going higher is not a strong bet, because bears will be looking to sell at and above highs, above 25 and above the high of the day. Probably sellers around the 26 high. We're always in long. The bulls were able to stop the market from going outside down. They're hoping that this is an opening reversal up from around the 60-minute moving average, and that it's going to be a bull trend. Everybody knows the odds are against a big trend. We have a very quiet day so far, and we have a very important announcement at 11 o'clock. And therefore, buying high is a lower probability bet. So the 30 stop entry bulls, I would not do it. You can see the limit order bulls made their money. They bought the 28 low, and it had to go up 5 ticks, which it did. And part of the pause up here is from those bulls selling out of their longs, unwilling to hold for a swing up. For the bears, second entry short and a wedge with 14 and 25, but I think it's better to be selling with limit orders above things like above 26 and buying with limit orders below things like below 28. It's a stop order short, but if you sell below 32, it has to fall 6 ticks down to here. I'm not sure that it's a good enough stop, so I would not take the stop entry short. We have a wedge, nested wedge. We have 1, 2, 3 inside of 1, 2, 3. Bears probably selling up here. We have a gap, 30 low and 24 high. And measured move is a little bit higher. Not many bulls willing to buy the breakout up here, even though always in long. We're in the sell zone. It's possible this could become a small pullback bull trend, but not likely. Stop order bears, it's a nested wedge, but I'd rather be selling above bars, above 26 or above 31, and I'd rather be buying low, like down here at the bottom of this small wedge. Strong enough breakout, 24, 25, might get one more push up, so it might be 1, and then second, 2, and then 3. Always in long, probably sellers above bars, but we might get one more push up, and we may stay very, very quiet. We may start doing this into the 11 o'clock report, and then the market will probably change its character for the next several days. So we'll probably start getting swing trades again, or a lot of trades. Sometimes it's hard to shift your mindset from taking very few trades when the market looks like this to taking a lot of trades, but that probably will take place today. Can you buy this as a high one? I would not. The rally is just too weak. So, traders want to buy with limit orders. I personally did not even buy the 34 low because of the possible wedge. So I'd rather be looking to sell up here. But, this is becoming very, very quiet. So I'm not sure that I'll sell the 34 high. I'll probably wait. This might become even more quiet over the next hour. I mentioned at the open that sometimes in the hour, maybe 30 minutes before the announcement, the market starts to trend. And a lot of times it'll look very convincing, but the probabilities are not as high as they would be if we did not have the FOMC report coming up. And a lot of times you'll get a really good looking setup, either the bar before the report or, 5 or 10 bars before the report. But, I usually do not trade it because too much of the time, the setup does not trigger until the report. And remember, the report has a 50% chance of going the wrong way. And it can also go very quickly the wrong way. So you can end up getting a lot of slippage, getting stopped out with a big loss, much bigger than your intended reward. So we may end up doing nothing until 10 minutes after the report at 11 o'clock. Since I'm not going to trade going into the report, I'm going to step out for a few minutes and I'll be back in about a half hour. I'm back. Technically, is it sell to close? I wouldn't do it. I'm going to wait for the report. Remember I said that early on we had a 50% chance of having an outside down day and that it might not occur on the open. It may come later in the day. I still think there's a 50% chance. Yesterday's a doji bar on the daily chart. The day before was a doji bar, so a weak buy signal bar. We had 8 consecutive bull days, unusual, and we have a parabolic wedge, and we've broken above the prior high, the August high over here, and we've broken above 2,500. So the bulls have done a lot. I think they'll take profits soon. Will it reverse down today on the FOMC meeting? I don't know. I still would like it to go up and then down, but it might simply go down, and that's why I put on puts and put spreads the other day. Usually when it's this strongly up, it's not going to go straight down without going sideways. But because it's such a big event, I didn't want to take a chance that if it does have a huge bear day, I want to be positioned. And if it goes up, I think it'll fail. As I said, it might go up 20 or 30 points, but I doubt that it's going to go up much more. All right, so for the bulls, they have another higher low, and they're hoping this is a failed reversal. It's a strong enough reversal like this, so the bulls will want a micro double bottom. Here we went up, we went down, we went up again. And here we have an II bear flag. Room to yesterday's low, only a couple of points down. I would do nothing here. If I were short, I would get out above a bull bar, probably 47. If I was not already out, I probably would have, had I shorted, I would have scalped out. And I would not sell closes this far down, even though I believe right now, I believe there's better than a 50-50 chance that we will go below yesterday's low, but we might wait until the 11 o'clock report to do it. In any case, I would treat this like a sell to close, and if I were short, I'd get out one tick above a bull bar. And it's too close to the report for me to be buying with a limit order at the bottom of the II or the 47 low or the 20 low or yesterday's low. So right now I'm trapped out. You can ask, well, who's trading? If you're not trading, Al, who's trading? I think it's institutional computers. I'm personally not. Once we started getting small and sideways about an hour before the report, I just stopped trading. Sometimes you get a leg down, sometimes it goes down and up, and you get stopped out for a loss. I want to stay fresh going into the report. because the report has the potential for a big swing up or down. I want to be ready for it. The report comes out in about a minute. As I said, I would not trade the first bar because 50% chance it'll reverse, even if it's big, even if it has a 10-point move, 50% chance it'll reverse. Usually when the announcement comes out, you get a big bar. And I don't know that this is big enough. I'm not really paying attention. But you'll know when it comes out. In the old days, the report sometimes would come out, 5 minutes late or even more. Now it tends to come out within seconds of 11 o'clock. So it's probably already out. Here we are, 40 seconds. Remember, I said that the reaction over the past 2 years has been mostly sideways. This is what a lot of the reactions lately have looked like. Reversals, but mostly sideways. This went sideways until the final half hour, then we got a bear breakout. And it looks like today is going to be one of those sideways days. However, I still think we're going down. That's why I bought puts or put spreads. Clearly, the market is extremely bullish. Daily chart, monthly chart, even more bullish, but it's too bullish. And it's overdone, so it should pull back. All right, remember I said that 50% chance we would go below yesterday's low. It looks like we're going to try to do that here. Again, I would wait until the close of the second bar. About 10% of the time I'll trade, during the first or second bar. 90% of the time I wait. There's the outside down day, traded above yesterday's high and then below yesterday's low. I'm going to just draw this wedge in here. Big bar. In absolute terms, it's not all that big. It's about 5 points, 4 points. Sometimes when you get an outside day, it goes outside down and then back to outside up. I don't know that we'll do that today. This, we went, that's not what I'm looking for. This is what I mean. We went outside up and then we went outside down. Same thing here. Outside up, below yesterday's low, above yesterday's high, and then back below yesterday's low. So there's a possibility that we could go back above yesterday's high. I just looked at some of my put spreads, and right now they illustrate an important point. And a put spread, I have some spider put spreads. Right now, both the long and short side of the put spread is profitable. And how can that be? Well, because we're down, that makes sense that if I'm long a put, we're going to be profitable. How is it possible that the short side of the put spread is also profitable? The short side is a lower strike put, far out of the money. And out of the money puts are always relatively overpriced because a lot of institutions buy out of the money puts because they cost less and they buy it for protection. And going into a big event like this, a lot of institutions buy out of the money puts. When the market does not collapse, that overpriced aspect of the put disappears. So the market can go down and the puts, those short puts can increase in value because the time decay, the risk premium built in disappears. And all of those firms who bought the far out of the money puts that I sold, excuse me, now have find out that the risk is not as great as they thought it might be, and the risk premium therefore is much less, and the puts are worth much less. So the puts that they bought are worth less, and the puts that I sold, the lower strike puts, are worth less, and I sold them, so now they're worth less than when I sold them, so I made money. Are we always in long or short? Well, we went always in short probably on 44, 45, and we did not get always in long here, so we're still always in short. But that big tail, 55, to me is warning us that we're probably not going to trend, and that today's probably going to be one of those FOMC days that goes sideways. Which is what most of the FOMC days lately have done. So big down, big up, and then down again, sideways, prominent tails, many reversals. So today looks like this kind of an FOMC day. Now, what about my comment that the market behavior is probably going to change starting 11 o'clock today? I still think it's true. I still think, even though we've had very tight ranges for 7 days, I think that behavior is going to end. I think it's too obvious. Too many firms are trading that way, and there are just not enough firms willing to take the opposite side of their position. If the market's in a trading range like this, traders, the institution, the programs are all selling high, buying low. So if you're an institution, you want to buy up here, betting on a breakout? No. So the firms trying to sell high eventually have to go higher to find sellers, because there won't be enough sellers at this price. So they may have to go up here, and all of a sudden the range starts getting bigger. The bulls who are buying low need to find traders willing to sell. And if you're trying to buy low, you may find that there are not enough traders willing to take the opposite side of your trade at this price. All right, so always in short, although one short, but big down, big up, big confusion, more likely sideways. But who's going to buy the 56 low? You can do it if you're a computer, but if you're an individual trader, I think you cannot take that buy. I think you have to wait. And because the reversal up is so big, I think it's probably not worth taking that short. I would wait to see if we get a bull reversal on 57. And if it's strong enough, then maybe buy above. But because we went down, we went up, we went down, and if we try to go up again, a lot of traders will scalp. I'm sorry, my mic was off. The 1 minute neckline, we have a double bottom neckline. Here's the 1 minute neckline, and that's one tick higher than the 5 minute neckline. The 5 minute neckline is the high of this bear bar. The 1 minute chart actually went up a little bit right before the close of the 5 minute bar. We are always in short, but big reversal up 55, big reversal up 57. A lot of traders are flat. This is reversal type price action, and that means increased risk and lower probability, selling near the low or buying near the high. Let me put up a 3 minute chart. When you see this, do you want to be selling with the stop down here? Do you want to be buying with the stop up here? No, it's a limit order market. So terrible for stop entries. 15 minute chart, possible failed breakout. Breakout below yesterday's low, breakout below today's low. But the bulls would like to get a decent bull inside bar. Even then, it's a fairly tight bear channel. For them, it's a wedge, 3 pushes down, 1, 2, and 3. Other ways to draw it, 1, 2, 3. again, this is looking like this, down and up and then sideways. It could be like this. We went up, we went down, we went up, we went down. We went up, we went down, we went up, we went sideways, right? So today is another one of those FOMC meetings, similar to, I would say, the majority of meetings over the past year. Most of the days have had this kind of price action, which is, it's bad for a trader. Monthly chart and bonds, this is probably the high of the next 30 years, and this is probably a head and shoulders top, left shoulder, head, right shoulder. We have a wedge, first leg down, pull back, second leg down, back to the daily chart. The right shoulder on the head and shoulders top is also a wedge. Here's the daily chart. This is the top of the wedge on that I just showed on the weekly chart and monthly chart. That's the top of the wedge. And now the daily chart has a wedge rally, left shoulder, head, right shoulder. And so the bond market is selling off a little bit more. And euro, wedge, first leg down, lower high, probably starting a second leg down. We have support here. We may bounce, but the target is this low. It's about a 400 pip reversal. Gold, outside down. I am flat. After FOMC reports, I prefer to enter with stops, and this is limit order behavior, and therefore I'm not trading. Daily chart, outside down, parabolic wedge, 1, 2, 3, or 1, 2, 3, micro double top. We still might have to go sideways more before we reverse down. Over the next couple of months, you can see this retracement down from the break. We broke above this high and reversed down and got fairly close to that low. I think when we do reverse down, I don't know if this is the start of the reversal. I think we'll go below this low. We have a bull channel, higher lows all the way up. 5 legs up in a broad bull channel is a lot. Usually the market begins to convert into a trading range after 3 or 4 legs up. This is 5 legs up. And therefore I think we'll soon enter a trading range, and the first target would be the most recent higher low. As long as this keeps making higher lows, bulls believe it's a bull channel. Since it's likely going to convert to a trading range, it probably will fall below a higher low to make bulls believe it's no longer a bull channel. And that means this low is important. It's around 24.14, 24.15 or so. And that's about 90 points below the high. That's the minimum target. And once we get there, if we do get there, we'll probably bounce and form a head and shoulder stop, left shoulder, head, and then right shoulder. And so I think if this is the start of the reversal, the market will probably enter a trading range for the next several months. And that corresponds to the monthly chart. 11 bar bull microchannel, extreme. You expect a 1, 2, or 3 bar pullback. 3 bars is 3 months of pulling back. Anyway, this is why I'm holding puts and put spreads instead of, because a lot of times the pattern on the 5-minute chart is really unclear and difficult. The one thing I'm confident of is that we're not going much higher, and therefore I probably will not lose money on my puts or put spreads. I think we're probably going at least below this high, the breakout point. So that means I'll probably make at least some money. and we may come all the way down here, which means I can make a lot of money. Will bulls buy the 55 low? It probably will be profitable because of how we reversed up on 55 and then again on 57. But right now I'm flat. And as I said, when you get an FOMC report, I prefer to enter with stops. If I were not talking, would I have sold below 58? I might have, with it closing on its low. You can see a lot of traders, as soon as 58 closed, they sold the market. And how do I know that? Look at the open and high of 59. It did not go above the 58 low or close. So as soon as 58 closed, a lot of traders hit sell the market. Back below 2,500, you can see the daily chart is becoming a big outside down day. I'm not taking profits on my puts yet. Clearly, strongly bearish. 5-minute chart ticks were mostly above 0, and then now after the report we got down near minus 1,000. Usually that is not the end of the move. Also look at the volume. Let me put up a 1-minute chart. Biggest volume of the day, usually not the final low. The lowest tick reading of the day, usually not the final low. So it's okay to be selling for any reason. Sell the market, sell above bars. The odds are high that if we reverse up here, even with a parabolic wedge, 46, 55, odds are high that the first reversal will not get very far. And still sell the market, sell the close. What are the chances of a reversal up? Well, from the parabolic wedge, you'd say pretty good. But, if you look at the ticks, I would say 70% chance that this is not going to be the low of the day. When you get a minus 1,000 reading and a high volume spike on the 1-minute chart, 70% chance it's not going to be the final low. Suppose the next bar is a big bull bar closing on its high. Well, I'll change my mind, but so far we don't have that. Traders still selling the close. Look at the open of 60 and the close of 59. Right? The open of 60 is below the close of 59. So as soon as 59 closed, even with the 3-point tail, a lot of traders just hit sell the market. But with that 3-point tail, I think we're probably going to go sideways, maybe up a little bit. When you sell that close, you get filled 1 tick below. It has to fall 5 more ticks to make money, and you can see it fell 6 ticks below the 59 close, which is exactly what it had to do for 1-point bears to scalp out. And you can see it fell exactly to where the bears could buy back their shorts for a 1-point profit. And you can see we're stalling there. So that tells you that a lot of the bears are concerned by the size of that 59 tail. And on this sell, they scalped for 1 point. Parabolic wedge. Now, what about taking the buy? I don't know. I probably we'll wait to see if we start to reverse up with 3 or 4 bull bars and then look to buy higher, or wait to see if we reverse up very strongly and then buy. I still think even with this big bounce, the odds favor a test back down. This is the 1 minute chart. Ticks minus 1,000, high volume. Obviously, the higher up we go, the less likely we'll put in a new low. This is not behaving in a particularly bearish way. Big tail 55, bull bar 57, big tail 59, and big reversal 60. So this is probably not going to be a big bear trend, and probably the best the bears will get at this point is a trading range. The bulls have a chance at a reversal. They want to get back above yesterday's low. So they cannot stop the market from outside down. It's already outside down. But they can try to erase some of the bearishness of the day going outside down. And one way to do that is to get back above yesterday's low. Will they do it? All this trading range trading today, probably 50-50 chance will close at or above yesterday's low. You also got 2,500, big round number, also a magnet. This is not behaving the way a strong bear trend behaves. We're getting huge bear bars, but big reversals. Sell off, big reversal, sell off, big reversal. And therefore, we're probably going to enter a trading range or possibly get a reversal. The most important price is yesterday's low. So we'll probably get up there by the end of the day and close right around it. Terrible follow through after the sell-offs. Not typical of a strong bear trend day. More typical of a bear leg in what will become a trading range. Who's going to sell below 60? Nobody, right? I'm not going to sell below 60. Probably buyers below 60. When it's too obvious, it usually does not get there. And what about my comment about the ticks, that the low price usually does not correspond to the low ticks? You can say, well, Al, this is the low price in ticks and it's right here. But, to me, this is still part of the same leg. This is part of the, so, and then here's the first real pullback. Usually, 60 or 70% of the time when you got a big bear breakout and ticks hit minus 1,000 like this, you're going to get a lower low. What's different is the size of these reversals, 55, 57, 59, 60. Probably buyers below 60, buyers below 59. We're still always in short, but I think most of the bears will get out above a bull bar 60. And the bulls, they're buying. We're getting these big reversals, but it looks like they're scalping because we keep working lower. 1 minute chart, probably buyers below the low of the day. And we'll probably, if we do get to a new low of the day, the ticks will probably be at a higher low, and we'll probably get divergence with volume as well. The volume of the low will probably be less than the volume of the current price low. That's what usually happens when you get a reversal. So if we're going to get a reversal and we get a new low, it'll probably come with less bearish ticks and with less volume. To me, today looks like one of the reversal type days. So this is probably comparable to this here. This is later in the day, and we went a little bit lower. But we're getting a lot of reversals. And I think when you get all of these big reversals back up, usually the day does not sell off very far. So we're probably at or near the low of the day. I think 60% chance we're going to get up near the low of yesterday before the end of the day. Obviously, if we get another leg down and we have bear bars closing on their lows, that percentage will get less. Not a particularly good looking II buy for the parabolic wedge, but I still think, we're getting big reversals after sell climaxes, and that usually means the market will evolve into a trading range. Therefore, we're probably not going much lower. Probably buyer 61 low, 60 low, 59 low. The 1 minute tick traders are trying to get to a new low, but I'm not sure that they will because of the parabolic wedge and the big reversals that we've had. Might be an outside up bar here. Micronoble bottom 60, 62, neckline 61 high. This is the neckline. You can call this big thing a double top. That's the neckline. I'm going to get rid of it. I think yesterday's low is more important, and I don't want to have too many lines on the chart. When buying in a bear trend, a lot of bulls want to buy above a bull bar. And we've had bull bars on the way down here and here. We have not gone above a bull bar. Plus the bull bars have had small bodies, big tails. I think better than a 50-50 chance we're going to get back up to yesterday's low before the end of the day. Remember my rule for sell the closed bears. They get out 4 ticks above any bar. We went 3 ticks above 61, or they get out above a bull bar. We have not gone above a bull bar. But as I said, I think we're going up. It would be nice if we get a bull inside bar here for a buy signal bar of 63. Suppose it's only a 1 tick bull body. Can you buy above 63? It'll be a second reversal up, failed breakout, yesterday's low. We've had parabolic wedge, so it's certainly an okay swing. It might be high enough probability for a scalp. And what about the tick traders? Well, it's never 100%. It's usually 60 or 70% chance the low tick reading and the high volume reading is not the final low. That means 30 or 40% chance it is. And given that we have a parabolic wedge on the 5-minute chart, that to me this is, I think the bears get out. Bears get out, and it's probably an okay buy, certainly for a swing, looking to get back up to yesterday's low. For the bears, it's a low too short, but unless we get a pretty good bear bar, I think a lot of bears will not sell. The bears see the parabolic wedge as well. Will the bulls take partial profits at one point? They might, but I think they have a good chance of making 2 points or more. I front ran this. I bought the close of 63. I just checked my entry price, and my entry price is at 98, one tick above the close of 63. So I may have been a second or two late on hitting by the market. $2,500, big round number. Some bulls bought above 59, and this is a 9-tick trap for them. And remember, we had strong sellers below 58, and we're testing that right now. Remember, we had traders who sold the close 58, and they got filled 59 open or 1 tick lower, and we're testing the resolve of the bears. Will they sell again right here? I would not. I think, we're at the 2,500 resistance, but we probably have to get closer to yesterday's low. I just got out with 2 points, even though we may go higher. Can we go back above yesterday's high? I talked about that sometimes when you get outside days, they go all the way back to the opposite side where they started. Market could not get outside down here. Could not get outside down there. Here, this is what I'm talking about. We went outside down. Well, it's still not what I'm looking for. This is the opposite, where we went outside up and then all the way back to a new low, then outside down. Outside up and then all the way back to outside down again. And what I'm saying today is it's possible that we go outside down and then all the way back to outside up. I do not think that will happen. I think we'll probably stay around yesterday's low and 2,500 for the rest of the day and then close either a little bit above or a little bit below. So I think we're right around the end of the move. We have big down, big up. It's a reversal, but most reversals lead to trading ranges. So is this going to lead to a bull trend or a trading range? Most reversals lead to trading ranges. It generates confusion. We went down a lot. Oh, we went up a lot. The market is deciding about direction. And usually you end up in a trading range. Sometimes you'll get a big reversal day out of it. I think the current bar is important. We're at a lot of resistance. 60-minute moving average, 5-minute moving average. Yesterday's low, 2,500, and we're stalling. Right? Strong reversal days that become strong bull trends, typically do not stall at resistance. Usually they break strongly above resistance. So I thought this might happen, and that's why I scalped out. What about selling below 65, double top, 58? I think it's clearly always in long. And the tick traders who were looking for a new low in price after such an extreme tick reading failed. They failed several times. And look at this, the 1-minute chart. We have a very strong rally unlikely to reverse without at least more of a double top. Therefore, even if 65 is a bear bar and we get a double top, you can call the double top with the 58 sell climax high, or double top with a little bounce on 57. You got a bull bar, so a double top. Probably buyers below. I think it's a low probability short. The reversal is strong enough up so that the bulls will probably buy the reversal back down, and we'll go at least a little bit sideways to up. I think we'll probably stay within a couple points above or below yesterday's low for the remainder of the day. So I think we'll start to do this, maybe not this tight, but we'll start to oscillate around all of this resistance. Is it by the close? No. To me, if 65 is a big bull bar closing up here, then it's probably by the close, even though we still have not gone above all the bars to the left. At a minimum, the bulls are trying to avoid a bear body to confirm. They want confirmation. They want 65 to be followed through. At a minimum, the bears want a one-tick bear body, but they would like 65 to close on its low, because that will make a lot of bulls hesitate to buy the 65 low. If it does not close on its low, if it has a 2 or 3 tick tail on the bottom of the bar, bulls will probably buy below 65, even if it has a bear body. They'll view it as a bad reversal attempt, and a bad reversal attempt means a bull flag. Just like there was bad follow through on the way down, there probably will be bad follow through on the way up. And like I said, I think we'll probably close right around yesterday's low. So why all the dojis? Because we went big down, big up, and we have a lot of resistance. Resistance doesn't mean the market can't break through it. Resistance is a magnet, and the market gets drawn to it. And we have several things going on right here. We have the 60-minute moving average, yesterday's low, the 2,500 big round number, and I think there's enough of a magnet here so that if we go down a couple points or up a couple points, we'll probably get drawn back to the magnet by the end of the day, and then close either a little below it or a little above it. Now, I said that we have a lot of magnetism around yesterday's low. And because of that, if we go down a couple points, guess what? Buyers below. If we go up a couple points, guess what? Sellers above. All right, so traders will buy. I don't know that they'll buy at the 66 low, but I think they'll buy 1 or 2 points lower and around a 50% pullback and around a test of these highs. Four consecutive bear bars, but still always in long, and still probably going to have a hard time getting very far from yesterday's low. You can call it a high 2 with 65, but 4 consecutive bear bars, probably more sideways. I think we're always in long. I think we'll probably stay always in long. We may get one more little push down. Sometimes days are just filled with two-legged moves. Other days are filled with wedges, and this is one of those wedge type days. We have a wedge, we have a wedge, we have a wedge, and bulls are hoping, well, we might get a wedge here, 1, 2, 3. Downside risk, small. Odds are we'll stay around here for the rest of the day. We may get one small, brief push down below 68. If we get above the resistance, if we get above 66, it probably will not get all the way back up to yesterday's high. We're always in long, so I think there's a better chance of the market getting here than there is of the market getting here. You can see we're right around the midpoint. Well, this is the midpoint of the two prices. but I think it's more likely we get here than here. But I think it's most likely that we'll stay within a couple points of the low of yesterday. Bulls trying to get above the all-time high, just like the bears would like to close the day on the low. Both will probably fail and will probably stay around where we are. I'd rather be taking the buys than the sells, because I think we're always in long, and it's more likely that we get there than it is that we'll get here. But I think we will get to neither, and I think we'll stay within a couple points above or below yesterday's low. Another high one. We have a high 2 bull flag, high 1, high 2. We have a breakout and a pullback, but big tail 71, doji 72, and tails here. I still think it's more likely that this is going to fail to get back up to the high of the day. But we're always in long, and therefore I think the downside is not very big. So I would not buy up here. Can aggressive bear sell here? Well, bar 72, the close of the hour, and this is what the hour looks like. It's a big bull inside bar, double bottom, slightly lower low double bottom here. I would not take the sell, but I would not take the buy either. To me, it's big down, big up in a 20 bar trading range. More likely, not many buyers above, more likely, mostly sideways. I am back to flat, and I did not sell. I would consider a stop entry sell, or if we had a lot of bear bars, I would consider selling. But this is looking pretty good for the bulls to get back up to yesterday's high. We have a double top 57, 66, and a breakout 73. And if we reverse here, that would be a type of wedge top. It would be 3 pushes up, even though it's not really a wedge shape. But whenever you have a breakout above a double top, you have 3 pushes up. The double top is 2 pushes. The breakout's the third. I still think the market is deciding between closing around yesterday's low and closing around yesterday's high. And even though 73 is a pretty good bull bar, I think the bulls need follow through. It's a big enough bull bar, I think, to make bears not sell below 74. Can you buy here? I would not. I think it was difficult. If I was typing, if I were not typing, I probably would have sold the 74 close for a 1-point scalp, betting that it was terrible follow through after 73, and the bulls hoping to get above yesterday's high will give up, and that we would get back to the open of the day, the low of yesterday. Too much of a reversal for me to buy above 76. Still always in long. For the bears, they have a failed breakout above a double top. That is a wedge. And then they have a parabolic wedge here. 1 down, 2 down, 3. But, I do not think they're going to get much of a reversal. I think, we've seen, we may go a little bit above 74 and form a wedge 1, 2, 3, but I still, to me it looks like we're going to close right around yesterday's low. This is a strong enough reversal, 64, so that it might have started the count over again. So this would be 1, pullback, 2, pullback, and then 3. So we might get one more push up. If we get it, we could get a stop entry sell, but we're getting very late in the day. And if a day is not clearly buy the close, sell the close, it's usually better not to trade this late in the day, because the best way to trade the market would be a limit order market. And this late in the day, I think it's really difficult to make money trading with limit orders. You don't have enough time left to scale in and use wide stops. Not a good looking high one buy, but too late in the day for me to sell, so I'm trapped out. I'm gonna have to create a section for outside down and up. And I have a section. This did not go all the way up. I'm trapped out. I'm not going to do anything here. Right now we're back near the open, so it's an outside doji bar after 2 other doji bars. I still think that the upside is limited here. I said that because of all the bull bars, I was probably getting short a little early. Here's the VXX. When you have that many bear bars in a tight channel, the market's probably not going to reverse up without first going sideways. And the opposite is true of the E-mini. When you have 8 consecutive bull bars, the market's probably not going to reverse down without going sideways, at least for a few bars. We may have to go sideways for a month, like this, or like this, or like this. I don't know. I suspect not, but we might. Anyway, that's why I bought puts in January, to give time for it to go my way. All right, so this is not what the market is seeing. I think it's not worth doing anything here. 74, not a good sell signal. 75, not a good buy signal. Mission accomplished. We got back above yesterday's high. However, we'll probably close right around, we got back above yesterday's high. However, we'll probably close around today's open, which is right where we are. The 2 choices I thought were closing around yesterday's low, which would have had a bear body on the daily chart, or closing back around yesterday's high. Only a 5-tick body on 78, but 50,000 contracts. Interesting day. I said that we've had too many tight trading range days in a row, and that the computer algorithms would stop working, because they would all be doing the same thing, betting on reversals, and we would end up getting swings. And with the FOMC report today, we got a swing down and a swing up. I think the odds are we're going to start to get swings again over the next few days. It's too late in the day for me to sell below 78, even though it's a wedge top. It's too late for me to sell it, plus too many bull bars. But overall, a fairly interesting day. We have a parabolic wedge going on the daily chart, 1, 2, 3, or 1, 2, and then today's high 3. We had a buy signal bar yesterday, but it was only a doji, and it's a parabolic wedge top, so probably not going much higher. As I said, we might go a little bit higher, but probably not a lot higher. Today's an outside day, following 2 doji days. That increases the chances that tomorrow will be an inside day, and if it is, especially if it has a bear body, that would be a second entry sell signal bar on the daily chart. So if we have a IOI with tomorrow being a bear bar, today was the entry for the first sell below yesterday's low, and if we get a bear bar tomorrow, that would be a second entry short, and that would be a higher probability short. It would be a second entry short for the failed breakout above the August high, and also for the parabolic wedge. That would be a higher probability for the bears. And for the bulls, we're still channeling up, and they hope that we go up indefinitely, but because we're in a broad bull channel, the odds are there are traders selling above this high, just like there were traders selling above this high. They had to sit through a pretty big pullback, right? You know, the market went up another 40 points above this high, but if they scaled in 20 points higher, right, then they ultimately made money. And the same is true here. You know, this high is around 24.87. We're almost 20 points above it. I guess we did go 20 points above it. So this is, to me, a reasonable short area. And then, you know, selling more 20 or 30 points above where we are now if we get there. What happens if we keep going up? Then the bears lose money, and my puts will expire worthless if I continue to hold them. I think the odds are I will make money, otherwise I would not have taken the trade. Monthly chart, 11 months without a pullback. Really, really unusual. So we'll probably get at least a 1 or 2 bar pullback like here. Here we had about 8 bars, we got a 1 bar pullback. And that means sometime in the next month or two, we'll trade below the low of the prior month. If we trade below this month's low is here, and it's about 50 points below where we are now. Weekly chart, bulls trying to get a good follow through after last week's breakout, but it's a very tight channel and it's going on for a lot of bars. Probably will have to go sideways like this for about 10 bars. That's about 2 or 3 months. So probably not much more left to the upside. 5-minute chart. We've had, I don't know how many days, like 6 or 7 days that have been mostly within tight trading ranges, and it was likely that today would follow that, especially going into the FOMC report. And we were fairly tight up to the FOMC report, and then we had a big breakout on 55. However, look at the close of the bar. You know, it reversed up pretty strongly, and then 58 had a bull body. We had a big sell climax on 59, but a big tail again and terrible follow through. Over here we had 4 bars without a bear body, and we broke below yesterday's low. We tried to reverse up above 61, but a doji bar, and then above 63. Now we have a micro double bottom and a decent bull bar. That's a higher probability buy. We should get back to yesterday's low and possibly up to yesterday's high, which we did. I thought we would close around yesterday's low, but we managed to get back to yesterday's high. All through here, we on bar 1 tried to reverse down from above yesterday's high, a bear body but a doji, so probably more limit order market like yesterday. The bulls tried to get an opening reversal up on bar 2, but you know, chances are we're not going to go that far up. You know, the bull trend is weakening. Yesterday was a doji bar. The day before was a doji bar. Probably not going to rally, especially going into the report. And then bar 3 I thought was interesting. It's not a good sell signal bar, but it's a second entry sell for a failed breakout above yesterday's high. Higher probability selling below bear bar 4. It went always in short on 5 consecutive bear bars. Not very strong. And then we had a small wedge down with 5, 7, and 10. Not a good looking buy signal bar. Tight channel. Probably we'll get a small second leg down, which we did on 17. And but terrible follow through on 18. Right from the open, I thought there was a 50-50 chance, maybe a little bit higher, that at some point today, especially after the 11 o'clock announcement, today would also trade below yesterday's low after going above its high. That would create an outside down bar. If the daily chart closed, if today closed on its low, it would create a big outside bear bar on the daily chart, which would increase the chances of follow through selling over the next few days. But instead, we got a outside down bar on the daily chart with a doji close. So not very bearish, not bullish, but not very bearish. The bulls erased the bearishness. Anyway, so over here, a lot of trading range trading. A lot of traders look for second entry buys near the bottom and second entry sells near the top. And we have a micro double bottom, 18 and 21, 18 and 20. So it's a second entry buy 21, but a big tail on top, probably not going all that much up. And then 30, we have an II, 4 consecutive inside bars, 29. We have a bull reversal bar, 30, probably not going a lot higher. The bulls who bought above 30 had a 5-tick trap. And then we had our nested wedge, 40, an II. We have a wedge, 1, 2, 3, a wedge, 1, 2, 3, 4. Not a particularly strong looking sell. More likely we would continue the tight trading range. More likely the tight trading range would continue, but we went always in short on 45. However, I'm not all that bearish. I want to wait to see what the report does. And we got an II there and a little bit of a bounce. And then we got the FOMC report. Very big bar, but very small body. And to me, that looks like a trading range, a 1-bar trading range, and it increases the chances that we're not going to go all that far down. We had a bear inside bar on 58 closing on its low after an attempt at a micro double bottom, and you can see traders sold it. And then 59, a big bear bar, but again a big tail. So we're selling off, but we keep reversing. Big tail 55, bull bar 57, and then big tail 59, bull bar 60. While it's possible the bulls will buy above 62, thinking it's a micro double bottom. It's an II. It did not have a bull body, and I think the bulls prefer to buy above a bull bar, which they got 63. Buying above 63 is the second entry buy, failed breakout yesterday's low. I think we'll get back to yesterday's low. I do not know that we'll get all the way up to yesterday's high, but I'm pretty confident that we'll get back to yesterday's low. And we did manage to get up to yesterday's high. For stop entries today, 2 is theoretically a stop entry buy, but I would not take it. We're trying to break above a tight trading range, and chances are we're not going to go all that much higher. Bar 4 is a better stop entry trade. Second failed breakout yesterday's high. Buying above 11, I would not. Selling below 17, second entry sell. You got a small double top, 6 and 14, and then a breakout and a pullback. Not really a good stop entry trade. And bulls bought the 10 low, bought more lower. The bears did not want to sell below 10 because this is a big magnet and we're getting terrible follow through after selling. Bears want to sell higher. And then we got a bull bar 20. And then, can you buy above 20? You could. I'd rather take a second entry buy like above 21. But I don't think we're going all that far up. And then buying below 28 after a 10-bar bull micro channel, probably going at least a little higher. And bears, though, will probably sell above 26 and sell above the high of the day. 4 remained the high of the day all day long. And then here, I would not trade it. If anything, I'm selling above bars using a wide stop, somewhere above the high of the day. And then on the way down, 39, a wedge, but tight trading range, not a very good stop entry sell. I would not buy above 49, even though it's an II and a higher low. And I would not sell below 53. 56, I would not sell below it. That big reversal up on the report on 55 makes me think we're probably going to get a reversal type of day after the report. 58, that was one I was talking, and normally I would take that sell. I would just hit sell the market as soon as 58 closed on its low. Stop entry buy at the low. To me, I bought, I bought a front ran 63, but buying above 63's high made sense. Selling below 66, I would not. Buying above 65, I would not. Buying above 69, I don't know that the probability is high enough for a scalp, but it's certainly an okay swing. Buying above 75, looking for the market to get above yesterday's high, I would not do it. Buy the close, sell the close. I thought we were probably always in short on 5, but I did not think we'd go down very far. maybe we're always in long on 25, but I would not buy that high up in the trading range. And then I stepped out a little bit in here, but I still would not have sold the close. We're too close to the FOMC report. And then here it was sell the close 58, and you can see everybody sold. Everybody in the world except me sold it and made money. And then it's probably buy the close 64, but we might get a deep pullback, and we may just go sideways around yesterday's low. And 73, I would not buy the close, and same with 76 or 77. 76, chances are we're going up to yesterday's high, and you can see as soon as 76 closed, it's the opposite of 58. As soon as it closed on its high, traders decided that we're going up to yesterday's high, and they bought the close and they scalped out. Limit orders, probably buyers below 1. I don't know if they're sellers above 2. And then through here, limit order bulls were making money. Limit order bears making money here. Not really good trading. Buying below 10, maybe better to buy. Second entry stop above 21. Buying the 29 low, I thought it made sense. And I also thought selling above bars, above 14, above 26, above anything was probably an okay scalp. And then here, going into the report, I would wait. And down here, the first limit order trade that I would consider was the 61 low, and the 66 low if you can use a really wide stop. But I would not buy the 66 low. However, I would buy 1 point below, 2 points below, or a 50% pullback, which would be somewhere down here. And then 74, probably buyers below, but too late in the day for me to trade with limit orders. Really interesting day. It's nice to see the range get bigger and the swings get bigger. Okay, question. I've been trading for 10 years and keep losing money because I keep shifting my strategy. I just trade the E-mini, and sometimes I scalp, sometimes I swing, sometimes I become a high frequency trader and hold, and I don't have the courage to keep any strategy going. I understand the markets well and have a good strategy, but make money is eluding to me. Any comments or suggestions? At what point must a trader quit? Well, I lost money for 10 years. It took me about 10 years to figure out how to do it. It's really a search for self. It's a search. You're studying your own personality and trying to figure out where you fit in the world. And the first thing I would do is stop trying to trade too much. I would stop anything that looks like high frequency trading, and I would stop scalping completely. And I would switch just to swing trading, and I would make trips to Walmart every day around 9 o'clock. I'm not being facetious. I'm being serious, right? I would go in the day with the intention of taking one trade a day. And if I get a decent setup, I take it. And if I don't get a decent setup, I don't take it. And I'm serious about that. And I would, if you've been trading a long time and you're losing money, I would go into the day saying, I got one bullet in my gun. And I get one shot at it today. And I'm only going to take a really good trade, like a second entry buy with a good buy signal bar of 63, or a strong breakout or a strong reversal. To me, I would not take these. Here, you had to be really quick to sell below 58, but either you buy the 63 high or you buy the 64 close and put a stop below 64 or below 62, and go to Walmart. Place a limit order for a measured move up, place a stop. So you buy that close and you place a stop below this bar or down here and place a limit order up there. If you want, you could just try to get out with 2 points. And the past 2 weeks, it's been really difficult. There were not a lot of 2-point trades, and I just wouldn't worry about it. However, what I'm saying is serious. I would just look for 1 or 2 trades a day. I probably initially would just look for 2-point trades. If like you got a clear buy the close bar 3, you just buy the close and maybe risk 2 points and put a limit order 2 points up there to take profits. And I would just do that and just say, I'm just going to take one trade today, and I'm going to pay attention carefully to the market, especially in the first hour or so, because that has the best chance of creating a good trade. And I'm only going to take the trade if it's pretty much perfect. So if it's buy closes, I need a couple consecutive bull bars. If it's a breakout, I need consecutive breakout bars, and I need both to be good. If it's a reversal, I want a micro double bottom like this, or second entry sell like that. And for second entry sell, I want to sell below a bear bar, like bar 4, not below a bull bar, bar 3. And just, you know where the stop is. So if you sell below 4, you put a stop above, you place a limit order to buy back 2 points lower. And if you have to, go to Walmart, go to the gym, go do something. But I think if I were in your situation, that's what I would do. I would forget about scalping, and I would forget about taking a whole bunch of trades. I would say I got one bullet in my gun today, and if I'm going to look really carefully for setups, trying to anticipate the setups, and especially second entry trades. Buying above 21, selling below 4. Buying above 63, and just wait for them, or wait for strong breakouts and then enter on breakouts. But don't enter on breakouts that are not when there are problems with the sell-off. We see the big reversal up on 55, big reversal up on 57, big tail on 59. That's not a breakout that you should be selling. That's not a good sell at close. 64, on the other hand, is a reasonable buy at close. And, so my recommendation would be to do that. You just look for one a day. If you find 2 or 3, that's fine. Some days there are 4 or 5. But I would just focus on one trade a day that looks reasonably perfect, and just take my 2 points, and then be happy. And I personally think it's a profitable strategy. And as you get better, I think instead of one trade a day, you might take 2 or 3 trades, 4 or 5 trades. However, I think that is probably the quickest way to get consistently profitable. The other choice is to wait for swing trades, and today would be hard. You could sell below 4, but you have to get out above 19, and I would not take the short below 40. And then here, that would be a swing trade. You just put the stop in, and then just ride it until you get a clear reversal. I don't think the reversal below 67, 68, 69 is strong enough to flip it to short. I think we're still always in long. And most days there's something that you can do like that. And if you, I just saw something. If you buy a close and you get a disappointment bar and then a micro double top, you just get out. Just take your loss and then patiently wait. Here we got a triangle at the moving average, failed bear breakout. That's another buy. That's another buy. If you don't take that buy, you see 3 bull bars closing near their highs, then just buy the market and place your limit order 2 points higher. You stop at the appropriate place and just sit. I know it's really nerve-wracking. You sit there and say, oh my gosh, it's taking 2 bars, 3 bars. I'm used to exiting in 1 minute or 2 minutes or 3 minutes, and now I'm sitting here for 3 bars, 4 bars before I get my 2 points profit. But that's what I would do. And if you find yourself scalping out with 2 ticks profit, 4 ticks profit, I would say just go for a walk. Place, once you're in, you place your stop order, place your limit order, and come back in a half hour. Go do something. Go to Starbucks. Walk around the block. Just go away, and come back. I had a friend years ago. I traded with him for several years, and he was a pretty good trader. He was probably making 10 to 20 points in the E-mini a day. Every day, around 9 o'clock, he'd say, Al, I'm going to go out to the lake and canoe for a couple hours and I'll come back. Or he was in his 70s. Or Al, my mother's in her 90s. She has a doctor's appointment. I'm going to take her to the doctor. And, he would be in his trade. He'd have an obvious stop and he'd have a limit order, usually 4 points or more. And he'd just disappear and he wouldn't worry about it. He'd come back around 11 o'clock and he'd say, I can see I made 4 points on that trade. And, I don't ever, I traded with him for years. And I don't ever remember him losing money doing that. I'm sure he did, but I certainly don't remember it, so, if you pick your trades well, with experience, you can, you'll be surprised, but it takes patience. And the rut you're in right now is you're so eager to make any profit that you want to take a really quick profit, even when there's a potential for a big profit. Also, when you're desperate for any profit, you find yourself buying in strong bear trends, selling in strong bull trends, arguing that the risk is small, right? If you buy blow bars and risk a point or two, or, you're going to say the risk is small, but you tend to overlook probability. It's really easy to focus on risk, and you start looking for trades with very little risk, but they always have low probability. Or you take quick profits, so you take trades with very little reward, and that's not good because it does not offset the risk sufficiently, so you lose money. So I would just, go in with one bullet in my gun today. I'm going to take one shot, and I'm going to go for a walk and come back in a half hour. And do not come back in 15 or 20 minutes. Come back in a half hour. So. But that's my recommendation to someone who's been trading for a long time and cannot make the transition to consistently profitable, and they find themselves, scalping regularly, going back to scalping. Whenever I hear that, I'm thinking that the person is desperate for a win, and they're only thinking about risk, and instead of trying to be objective about risk, reward, and probability. So I hope that makes sense. Okay, I hope everybody has a good night.